Coming up on Market to Market, the details begin to come forward on how the two major party candidates want to shape the economy. And diversification helps one state's dairy industry hedge against uncertainty. Those stories and market analysis with Don Roose next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, August 12 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. A first for the new millennium this week on Wall Street. The day before Y2K became reality, December 31st, 1999, was the last time all three major indices closed at record highs. Thursday, the trio was boosted by investor sentiment over surging oil prices and strong earnings by a pair of department stores. A day later, the monthly retail sales report revealed that consumers were cautious in July, and the figure was unchanged for the month. The Producer Prices Index retreated last month. The measurement of cost pressures before they reach the consumer fell by 0.4%, the biggest drop since September. And U.S. cropland value in 2016 is down $40 per acre to just below $4,100. This is the first decline since 2009, when the price per acre fell to $26.40. If you believe the bears, the U.S. economy is in a perilous position. The politicians wanting to be president have ideas, too, on how to fix what they see as a problem. Peter Tubbs reports.
Under my plan, no American company will pay more than 15% of their business income in taxes.
On the heels of an anemic GDP report, the campaigns for the presidency shifted focus to the economy and taxes this week. A paltry 1.2% economic growth over the last year brought a cascade of ideas from the candidates. Donald Trump emphasized trade issues and taxes.
We will work with House Republicans on this plan using the same brackets they have proposed, 12%, 25%, and 33%. I have previously laid out a detailed 7-point plan for trade reform available on my website. It includes strong protections against currency manipulation, big problem, tariffs against any countries that cheat by unfairly subsidizing their goods. And it includes a total renegotiation of NAFTA, which is a disaster for our country. A total renegotiation.
The Trump campaign also wants to cancel the Obama administration's climate action plan and the waters of the U.S. rules, as well as increase the amount of coal burned by utilities and industry. Democratic presidential nominee Hillary Clinton was also in Michigan this week. She countered with plans to increase spending on infrastructure, research and development, and technology. Clinton emphasized the financial potential of green energy, especially solar.
Some country is going to be the clean energy superpower of the 21st century and create millions of jobs and businesses. It's probably going to be either China, Germany, or America. I want it to be us. We invent the technology, we should make it and use it and export it.
Clinton hopes to power every American household with solar by the end of 2020. The secretary's technology push also includes a goal of bringing broadband to every home, including homes in rural America. The candidate's position on the Trans-Pacific Partnership mirrors Donald Trump's.
My message to every worker in Michigan and across America is this: I will stop any trade deal that kills jobs or holds down wages, including the Trans-Pacific Partnership.
Clinton also pushed her plan for higher taxes at the upper end of income brackets.
We should also add a new tax on multimillionaires, crack down on tax gaming by corporations, and close the carried interest loophole, something I've advocated for years.
Neither campaign has released details of their agricultural policy platforms. Advisors to the Trump campaign have suggested revamping the Farm Bill. For Market to Market, I'm Peter Tubbs.
According to the National Institute of Diabetes and Digestive and Kidney Diseases, nearly a third of Americans suffer from some form of lactose intolerance. This has prompted the creation of non-dairy alternatives. Coffee giant Starbucks announced this week yet another version for use in their beverages. The development of these new options has evaporated some of the traditional outlets for dairy producers and pressured already volatile markets. While Class 3 milk futures are trading at levels not seen since December, the chasm between a rebound from record highs contests the mettle of many dairy producers. As Josh Bittner discovered, there is hope, and diversification is leading the charge.
We know that after record highs come record lows, and we try to plan for it. We didn't go wild spending money last year, because we had it. Last year was nice, but you just can't plan on that.
Tim Taft's Vermont family farm has weathered booms and busts for decades. And true to form, the fourth-generation dairyman is riding out a downturn in milk prices, which this year have plummeted well below 40% from 2014's record highs.
We can't store our milk and hang on to it for a better price, so that does make it quite volatile.
For those faced with diminishing returns, USDA's Margin Protection Program, a provision of the 2014 Farm Bill, offers insurance. Payouts trigger when the difference between nationwide milk prices and feed costs drop below producer-specified dollar amounts. Last week, Agriculture Secretary Tom Vilsack announced the program's largest monthly payment. Producers who enrolled at the $6 to $8 trigger for 2016 will receive a portion of an $11.2 million disbursement. The dairy industry has called for further adjustments, prompting some to conclude the Margin Protection Program will be a central issue in the next Farm Bill. Taft admits buying into the strategy can be risky.
Grain here is quite a bit more expensive than it would be in the Midwest. They're going to make the margin greater when ours might be tighter. If we wanted to protect $7 of a margin, we may drop below that and not get paid anything because the whole country may average better than the $7 margin.
Diversification is another way to hedge against uncertainty. And among Vermont dairies, it's common to tap the state's abundant hardwoods each spring for added profits. The small New England state leads the nation in maple syrup production, cranking out close to half of domestic supply.
The sugar house is on one side of the road and the dairy's on the other, so sometimes they say the money has to go across the road.
However, some years maple harvest only lasts a few short weeks. So traditionally, milk and the range of products derivative of the liquid commodity have braced business tandems like Taft's against adversity.
When you talk about Vermont agriculture, not only are we a top dairy producer in terms of quality and one of the top 20 in terms of quantity, we also make some of the world's best cheeses. The artisanal cheese industry in this state is second to none.
Cheese is a $650 million wedge in Vermont's $2.2 billion annual dairy industry. And officials tout world-class quality of the Green Mountain State's strain. According to State Commerce Agency numbers, 60% of New England's milk supply is sourced in Vermont. And although the state does sell food across the globe, industry promotion groups like the Vermont Cheese Council advocate for so-called regional exports of products like raw milk cheeses, saying development and growth comes with almost no constraints or boundaries. But late last year, the U.S. Food and Drug Administration presented a hurdle when it changed guidelines for bacteria populations found in the Vermont staple. FDA decreased its recommendation for acceptable levels of non-toxigenic E. coli in raw milk cheeses from 10,000 mpn, or most probable number of microorganisms, to just 10 mpn per gram. Local producers and national lawmakers protested the move, claiming the added stringency is inconsistent with internationally recognized cheese standards, and unnecessary because the strain of E. coli mentioned is typically not harmful to people. And recent FDA test results on commodity cheese samples concluded the overall contamination rate for generic E. coli was not high enough to conduct additional large-scale sampling. So instead, the agency will utilize a smaller compliance program as necessary.
Without high-quality milk, you don't have high-quality cheese. There's a lot of care that goes into producing cheese milk. Cheese milk and fluid milk are quite different. We work to produce a clean raw milk that we do pasteurize for some of our cheeses, and we certainly pay for it. Good, handmade, hand-grown food in general deserves a higher price tag.
Situated in the pristine Northeast Kingdom, a region nestled between the Green Mountains, Canada, and the Upper Connecticut River, Jasper Hill Farm produces cheese aged in bunker-style cellars on site, along with product from competitors. Quality manager Adam Smith finds such partnerships benefit much more than just the bottom line.
What's awesome about Vermont is a community of cheesemakers. There's a lot of support, there's a lot of exchange of ideas.
While milk-to-cheese conversion generally takes just a day, fermentation is the X factor. Some cheeses age for 2 weeks before being sent to high-end counters and supermarkets across the country. Other varieties can take up to 14 months for internal chemical changes to steadily improve texture, taste, and return on investment. And while the margin between risk and reward remains difficult to predict, Vermont's agricultural advocates are confident the cream will rise to the top.
Since 2009 to 2013, we've added over 4,000 jobs in the farm and food sector alone. That's real growth in a small state like this. Our dairy producers are providing great raw product, and our cheese producers are just killing it when it comes to all kinds of different kinds of cheese that are being sold not only here in Vermont, but quite frankly, worldwide.
For Market to Market, I'm Josh Bittner.
Next, the Market to Market Report.
The sideways two-step played out this week ahead of Friday's USDA reports. For the week, September wheat grew 7 cents, while the nearby corn contract continued its slide, declining 2 cents, down 27% since mid-June. Increased export demand helped support soybeans as the September contract gained 11 cents. September meal shed $1.90 per ton. In the softs, December cotton shrank $6.09 per hundredweight. Over in the dairy parlor, September Class 3 milk futures dropped 13 cents. The livestock sector was mixed again this week as the October cattle contract lost $1, September feeders added 35 cents, and the October lean hog contract closed up $1.70, ending an 8-week losing streak that saw the market erode 32%. In the currency markets, the U.S. dollar index weakened 45 points. Crude oil gained $2.69 per barrel. Gold rallied $8.80 per ounce. And the Goldman Sachs Commodity Index increased more than 8 points to finish the week at 349.95. Here now to lend us his insight on these and other trends is one of our regular market analysts, Don Roose. Don, welcome back.
Thank you, Mike.
Friday saw the release of the much-anticipated USDA production and supply and demand reports. Big numbers in corn, big numbers in beans, globally and domestically. I want to get your thoughts on a question right off the bat. This is from Justin on Twitter. We ask all of you to send in your questions via Facebook and Twitter at eFarms5. He's asking, or he says rather, he doesn't disagree that it's a great crop, but 11% larger than last year's great crop? That seems like a big hurdle. These numbers were huge. Are they realistic?
Well, that's a good question, number one. But I think when you look at it on Friday, the market reacted initially negative to the report. We were down like 9 cents on corn. We end up closing higher. Same thing on wheat, lower. Same thing on soybeans. So I think when you look at it, the trade is very skeptical. I mean, we're skeptical at U.S. commodities of the numbers. Part of it comes the way the government calculated their yields. On the corn, for example, they had the ear count at a 3-year low. But at the same time, the weights they had at a record. So, it's very, it's very suspect. The same thing on soybeans. You jump to a 48.9 yield, record yield, and we still have the month of August to go. Anything can happen from here forward. So I think what the market told us on Friday is those big yields are very suspect, and we're trying to see what the actual yield's going to be.
All right, well, then let's talk about this wheat market. We've been hoping for a bottom in here somewhere. We're actually up a little bit this week. Have we found support down here in that 420 range?
Well, yeah, I think when you look at the same thing on the wheat market, we have huge supplies, but what we're really trying to do is balance, do we have a big demand to offset that? And basically, we continue to get negative news on the wheat market, but we really aren't going to the downside very far. We've been in a trading range at the bottom end of the range for 3 weeks now. We're trying to score a low. This time of year, we do that. We did have some things out of the report. It was a negative report, no doubt about it. We have stocks-to-use ratios in the U.S. that are almost 50%. We did cut the EU crop 9 million metric tons, but then you raised the FSU crop 11 million metric tons. So in the end, you end up with ending stock in the world going up, the U.S. going up just mildly, and we have big crops, but we're sitting here at low prices.
So hopefully we can build that demand through low prices.
Well, I think when you look at it, at some point in time, you say how low is low, and that's what we're trying to figure out. We're at low levels. The government has the actual cash price for this next year on wheat at $370 average, with a $405 on the high side, so $335 on the low side. So cash-wise, we're probably getting down to the low end of the range. Basis levels are very soft. There's big carries in the market.
Okay, let's jump into this corn market. 175.1 national corn average was what the USDA put out. I'm only aware of one analyst that was even close in there at 175, but like you say, the trade was unfazed. Where does that send this market in the next week?
Well, I think when you look at it, it's number one, we're probably down at the bottom 10% of the lows for the year, but at the same time, this is no time of year to be bullish on the market. It's because seasonally it's just the wrong time, and if on the bear side, there's no reason to really be that negative. So really where we're at, Mike, is we're caught in a trading range. We're going to see if these are the high watermark on the yields. It's very possible that could be. Typically we say big crops get bigger, but this may be an unusual one that doesn't happen. So we'll see as we go forward. It looks like the government was using the crop ratings as a big gauge going forward, and those big ear weights are really a questionable mark. So, we'll see, but we do have big carries in the corn market.
So if we don't have to be making any sales in the short term, and let's talk new crop, if we don't have to be forward contracting anything today, best advice is to wait till the combines start to roll, do you think, before putting some sales in place?
Well, I think if you have to just catch up sales at these levels after you see the crop report, it doesn't look like rallies are going to be sustained. It looks like you get a 10 to 20 cent rally. That's going to be pretty hard fought to go past that, at least until we get further into the harvest, until we see what the yield is going to be. But from a producer standpoint, when you're down at the bottom 10% of the crop year prices, you probably should use what you have for an opportunity, and that's the East July corn spread. You have a 24-cent carry. So try and carry your corn, take advantage of those higher prices. For example, if East corn would get back to $3.50 a bushel, you're at $3.75 July corn, but make sure you do something about it. So there's some opportunities, but it's more in the merchandising than it is flat price.
Now, 25 cents for 6 months storage, does that work for a lot of producers?
Well, I think when you look at that from an overall month standpoint, that comes out to about 3.5 cents a month storage, 1 cent interest. So you're getting 2.5 cents a month for your storage. So I think it's much better than soybeans, where there's an inversion, so it definitely doesn't work on soybeans.
And let's talk about that soybean market. Like you mentioned, big yields, we're seeing big crops. And the market's higher on the week. Export demand continues to be strong. Is this a market that we are confident we have sufficient global demand to keep these prices in the mid-9s, upper $9 range?
Well, the bean market is all about the demand because the supply is huge. And same thing with corn. It's all about the demand. Can you stabilize us down at this level? This last week we had, out of 12 days, we had 11 days of export sales. So the demand is strong, but we're relying on the Chinese business. If they change, slow down, the market slows down. But really the job of the market by the U.S. producer and the merchandiser is to sell these upfront premiums. November's trading 15 cents over July. Sell that premium before we hit South America, because remember, not only on soybeans but corn, you're going to have a window until about January, February, and then you're probably, without weather problems in South America, you have massive crops coming at us. So use our marketing window, us versus South America, as an opportunity.
Now, that being said, are you using it today, or do you want to, again, wait a little bit until the combines start to roll before you start using that inverse in the market?
Well, you know, you have to be careful that others don't start to take advantage of the inverse. So if you get rallies back to $9.90 to $10, $10.20 on November beans, those are definitely catch-up sales after we see the big yield that the government put out. And the same thing with corn. You get 10 to 20 cent rallies. Make sure you look at those as catch-up sales opportunities cash-wise, or use the carrying charges.
Okay, now I want to spend just a minute on cotton because we did have a big downside move there, $6 on the week, but held at $70. Where do you see this going from here?
Well, the cotton market really topped out up around $80. It put in a nice technical top. Big support, you know, at these lows down in that 70 area, 65. I think that the cotton market probably is an overachiever. Funds piled into the market. It was all about the Chinese again. You know, we keep bringing their name back to the forefront. But, you know, I think the market on the cotton market probably is going to be similar to the grain market. It probably chops lower over time.
Okay. Now let's talk livestock. Don Roose, you do a lot with cattle. We've seen a little bit tighter show lists and a little bit of stability, I guess we can call it, in the fat cattle market, live cattle, down $1. What are you seeing on the cash side here as we close out this week?
Well, the technicals remain positive, you know, just barely. You know, we keep breaking the cattle market, but it keeps bubbling back here. So part of it is because the discounts are just too big. October cattle today, they're trading about $114.50. They should be trading $119.50. So it's just too big a discount. Basis is out of line. The cash market, typically this time of year, bottoms, starts to move higher gradually. The government in their outlook meeting on their supply-demand table on Friday said the same thing, looking for the third quarter to be 116 to 120. They came back to realistic numbers. The fourth quarter, 118 to 126. So I think what we're really saying, the cattle market with tepid demand probably tries to firm up going into the fall. But when you get up into those numbers that look realistic, 120, 122, that might be the upper end of the range.
Okay, so be pretty aggressive on risk management up in there.
Yeah, we think you have to be. The competition in the world is just still too great. We're going to have you know what the market was this last year. Next year we're going to have 3% more production again. So we're going to have to figure out how to consume it or sell it.
And that's 3% production, assuming not the sky-high weights we saw in 2015, right? Assuming traditional weights.
Yeah, that's just the normal production that the government is putting out. So we're going to have a lot of meat to chew through. And, you know, we're still concerned, Mike, that we're still in a multi-year bear market, and we still have another 18 months to 2 years to really get through it.
Okay, 18 months to 2 years. How much lower can we grind? What's your worst bear picture on live cattle?
Well, we started the whole move in 2010 at 85. If you look at the hog cattle ratios, going back to 85 to 90 would just put you back in a ratio where you can compete and sell meat. So you don't like to hear it, but it might be something to look at unless these other meats find some strength.
Okay, feeder cattle continue to rally. We've had several weeks to the upside here in feeders. Do you want to be an aggressive seller of this feeder cattle market up here, or does it have room to go?
Well, I think it's like the cash cattle market. I think it has room to move back up. But, you know, if you get the November feeder cattle back up to that 146, 147, 50, I think those are more catch-up selling opportunities going into the fall again.
Okay, lean hogs. This is a market, it seems like every week we seem to get the question, is it safe to buy lean hogs? We've been on this massive downtrend since we topped out in this market earlier in the summer. $1.70 higher this week. Did we put in a solid bottom?
Well, we think that we might put in an intermediate bottom. But you still have to be questionable here. As we go forward into the fourth quarter, we're going to have third quarter 4% more pork than a year ago. Fourth quarter, we're going to have 3% more supplies. So, you still have a lot of supplies to chew through. There's a lot of meat out here yet. So if you really look at it, Mike, where the government in their outlook meeting, they put the fourth quarter at 53 to 59, the first quarter of next year at 53 to 59. So rallies on the dress basis. So rallies are meant as risk management opportunities. $3 to $5 rallies are probably more hedging opportunities, and look for continued large supplies coming at you. And Chinese demand has been soft. That's the problem.
Okay, and as we watch the rest of this year unfold, is there anything that could spark that Chinese or other demand around the world? Is there anything in your mind that really could get this hog market fired up from an export perspective?
Well, the big elephant in the room, of course, is the Chinese market. That's what everybody's counting on, and hasn't gone so well. We had 3 weeks out of 5 where they actually canceled pork, didn't buy it. So the other one that's the obvious is the dollar. If the dollar would happen to plummet, that's probably something that could help us. Or a disease problem in one of the foreign countries, which is always an issue if it doesn't pop up here. So disease, the dollar, and the Chinese are probably the things to watch.
All right, now talking about the dollar, if it would plummet, from a technical perspective or a fundamental perspective, what's the likelihood of the dollar dropping too much further, say to the 90 level?
Well, when you really look at the dollar, we're the best of the worst. We still have interest rates that are trying to go up. The rest of the world is still trying to go down. We're stabilizing. Our economy's going up. So at the present time, you just don't see it. In fact, actually, you think the dollar probably stays firm going into the end of the year and into the beginning of next year.
Make another run at parity at 100?
I would say that's a better bet going to parity than it is to going to 90, so I would say that's probably the case.
All right. Well, Don Roose, thank you so much for joining us this week.
Thank you.
That wraps up the broadcast portion of Market to Market, but Don and I will keep the market conversation going, including answering more of your questions during Market Plus, available on our website. Did you know Don Roose grew up on a farm? Hear his backstory and other analysts and producer stories in our new podcast, M2M. You can listen on our website or find it where you regularly download podcasts. And join us again next week when we'll see how an FFA project turned into a large operation for 2 brothers. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.